Central banks play a crucial role in managing monetary policy to promote price stability, sustainable economic growth, and financial stability. Over the years, they have used various strategies known as open market operations to influence the money supply and interest rates. One of these strategies is quantitative tightening, which refers to a deliberate reduction of liquidity in the financial system by the central bank. How does it work and what are its implications? Quantitative tightening is exactly the opposite of quantitative easing, a strategy used by the central bank to inject liquidity into the financial system during periods of economic difficulty. QT leads to a reduction in the size of the central bank's balance sheet, as well as a withdrawal of excess funds from the economy. The central bank achieves this by selling securities, such as bonds or treasury bills, that it had acquired during the monetary easing phase, known as QE. Implementing quantitative tightening has very significant implications for the liquidity of the economy. As the central bank sells its holdings of government securities, the excess reserves held by commercial banks decrease, leading to a reduction in the overall money supply. This has the effect of reducing the availability of funds for lending and investment activities. Why do we do this? Quantitative tightening can put upward pressure on interest rates, which can help fight inflation. Indeed, as the central bank reduces liquidity, borrowing becomes scarce and expensive for both businesses and individuals. Another aspect is the price of assets, whether stocks or real estate. During periods of QE, the injection of liquidity into financial markets led to an increase in asset prices, stocks, bonds, and real estate. As QT is implemented and liquidity is withdrawn, the opposite effect occurs, leading to corrections or potential declines in prices. Quantitative tightening can influence exchange rates. When a central bank reduces liquidity, it results in a tightening of monetary policy compared to other countries. As a result, the country's currency may strengthen against other currencies due to increased demand, which can impact competitiveness and the balance of payments. Finally, the goal of quantitative tightening may be to give the central bank's balance sheet some breathing room, since obviously it is not meant to expand indefinitely. In such a case, quantitative tightening will require close coordination between monetary authorities and fiscal authorities. While the central bank reduces its liquidity, fiscal measures can be implemented to ensure adequate support for growth and economic stability. Such coordination is essential to mitigate potential negative effects on the economy and to promote overall financial well-being. So, as we've seen, understanding the implications of quantitative tightening is essential for economic policymakers to navigate the evolving landscape of monetary policy and its impact on the broader economy.